Hey guys, welcome to another investment analysis Excel video. See, the following are the monthly rates of return for Madison Software Corporation and for Kayleigh Electric during a 6 months period. We are going to compute the expected monthly rate of return for each stock, standard deviation of returns for each stock, the covariance and correlation coefficient between the rates of return. So let's get started. First, I'm going to compute the sum for Madison Software equals sum, parenthesis open, select the data, parenthesis close, enter. Same I'm gonna do for Kayleigh Electric return equals sum, parenthesis open, select the data, parenthesis close, enter. Now for the expected rate of returns for Madison Software equals the sum product divided by the number of periods or the number of investments, which is 6, enter. Same I'm gonna do for Kayleigh Electric expected rate of returns equals the sum product divided by 6, enter. Now I'm going to subtract the actual returns minus expected returns for Madison Software equals actual return minus the expected returns, enter. Before I put a log on both sides, press F4, enter. Now click on the bottom rifle handle over here, and when you hold your cursor on it, it will become up, a dark plus sign, and just select, drag this formula all the way down. Yeah, this way. Same I'm gonna do for actual rate minus expected returns for Kayleigh Electric equals actual return minus expected returns. Before I put a log on both sides, press F4, enter. Now drag the cursor all the way down. Yeah. I'm going to compute the sum for Madison Software equals sum, parenthesis open, select the data, parenthesis close, enter. Same for the Kayleigh Electric equals sum, parenthesis close, enter. Now, for the calculations of the covariances, I'm gonna multiply the rate of returns minus expected rate of returns for all the companies equals actual rate minus expected rate returns for Madison Software multiplied by Kayleigh Electric, enter. Now click on the bottom rifle handle over here, drag the cursor all the way down. Now for the calculations of the covariances, I'm gonna multiply the rate of returns minus expected rate of returns for all the companies equals actual rate minus expected rate returns for Madison Software multiplied by Kayleigh Electric, enter. Now click on the bottom rifle handle over here, drag the cursor all the way down. Same I'm going to compute the sum parenthesis close, enter. Now for the calculations of standard deviations, we are first going to compute the variance. For variance equals this value square or square caret 2, enter. Click on the bottom rifle handle over here and drag the cursor all the way down. Same I'm gonna do for Kayleigh Electric equals this value, square it down. I'm going to compute the sum for both equals sum, parenthesis open, select the data, parenthesis close, enter. Equals sum, parenthesis open, select the data, parenthesis close, enter. I'm going to compute the variance as per the formula equals the sum product divided by the number of periods or investments, which is 6, enter. I'm going to take the square root of the individual assets in the two asset portfolio for Madison Software equals square root of the variance SQRV parenthesis open, this value parenthesis close, enter. Same I'm gonna do for the variance of Kayleigh Electric equals the sum product divided by the number of investments, 6, the number of years, enter. Now the standard deviation of the individual assets in the two asset portfolio for Kayleigh Electric company equals square root parenthesis open, this value parenthesis close, enter. For the calculation of covariance, this is the formula. Covariance is basically a measure of how the stock returns of Madison company and Kayleigh Electric co-vary with each other. If the covariance is positive and high, that means there's a lot of, if one rises and the other rises, and if one falls and the other falls, and so on and so forth. So let's measure covariance of Madison and Kayleigh Electric as per the formula equals the sum product of the multiplication of rate of return minus expected rate of return for both companies, this value divided by the number of periods, 6, enter. Now for the calculation of correlation, this is the formula equals the covariance divided by standard deviation of Kayleigh Electric and Madison Software Corporation. So equals, we have computed the covariance so far divided by standard deviation of Madison Software multiply standard deviation of Kayleigh Electric. Correlation is covariance normalized to say between -1 and 1, you think that way. So there is a positive correlation between Madison and Kayleigh Electric. The most positive it could be is 1 or more closer to 1, where it's 0.6818. One should have expected a positive correlation between two stocks since they tend to move in the same direction. Risk can be reduced by combining assets that have low positive or negative correlation, which is not the case for Madison and Kayleigh Electric. We are finally up to the calculations of standard deviation portfolio. This is the formula to calculate the portfolio standard deviation. The WI square represents the weight of one asset in the two asset portfolio, whereas this W2 square represents the weight of other asset in two asset portfolio. Similarly, this rho 1 square represents the weight of one asset in the two asset portfolio, and this rho 2 square represents the weights of the other assets in the two asset portfolio, and this represents the covariance of the returns between these two stocks, the Madison companies and Kayleigh Electric company's stocks. Alright. Now, if you have a portfolio of both these stocks, that means, let's say, if you have a 50% of Madison and the rest of it as Kayleigh Electric. So basically, if you have $100, you allocate $50 to Madison company and $50 to buy Kayleigh Electric. So if there's a case, then you have a constructed portfolio. The return of the portfolio is very returns of the Madison and Kayleigh. So Madison's returns times Madison weight plus Kayleigh's returns times Kayleigh's weight. Alright. So you really want a stock that has the lowest possible risk and the highest possible return. I've already done the risk calculations according to the formula. This is the whole sum of the individual weights of the assets in the two asset portfolio for Madison Software and Kayleigh Electric. So this is the covariance of the returns between these two stocks. Now I'm gonna take the square root of this whole sum product. Square root of this whole sum, parenthesis close, enter. Now we finally completed the standard deviation portfolio. If you guys like this video, give this video a thumbs up, and if you want more of these videos, then stay tuned to the channel. Take care. Bye bye.